Hello, everyone, and thank you for joining us today. I'm Cassie Adolph, and welcome to our Commodity Insights webinar series. For those of you that may not be familiar with StoneX or joining us for the first time, welcome. StoneX is a global Fortune 100 financial services organization, and the key pillars of our business are really to connect clients to markets and to ensure we're helping clients control commodity costs. We do this through our deep boots on the ground expertise around the world. We do this through our high touch consulting services. We do this through our end-to-end clearing and execution services. And we do this through our digital platforms. And we are here today bringing you insights across all your key commodity sectors that will ultimately drive the profitability of your business. So let's take a look at today's agenda. We have a panel of our best experts across the firm, across a number of commodity categories today. We are going to be keeping it high level and giving you the key insights on each market. Know that you can reach out to any of these market experts by taking a deeper, if you'd like to take a deeper dive later. All the speakers' bios are on the right-hand panel, and you can click through and email them right from there. We are going to kick off today's 2-hour webinar with Kathryn Rooney Vera. She is our Managing Director and Chief Market Strategist at StoneX Group. Following Kathryn, we'll be jumping into the market category presentations, starting with Josh Cannington on interest rates, Dan Conrath on energy, Craig Turner on grains. We'll move into Nate Donnet on dairy, Gavin McPherson on livestock, and we'll be wrapping it up with Alfredo Nicastro on carbon. The majority of these panelists have been with these commodity insights for nearly 15 years or more, so it's a deep bench of experts. We're really excited to bring this to you today. Just a couple housekeeping items to begin. We encourage you to ask questions to all of our speakers. As you have them, type them in the question box found at the bottom of your screen. We'll be working them through the webinar throughout as we have time. At the bottom of your screen, you'll also see several engagement tool icons. You can open and close those throughout the session. All of those are resizable and movable. You can expand your main slide area. You can maximize it to full screen by clicking on the arrows in the top right-hand corner. And the last note here is we will be recording the session. So if you'd like to refer back to any of the content later, you will be receiving a link in the coming days in your inbox. Okay, well, with that, I would like to hand it over to Kathryn Rooney Vera to get started. Kathryn, the floor is yours.
Thank you very much, Cassie. It's a real pleasure to be joining you and your client base. I'm coming to you from Washington, D.C., where I am attending the spring IMF meetings. And there has been lots of interesting data coming out from policymakers and from real money accounts that we've been talking to. So let's get started. Where are we in the economic cycle? I think that's, Cassie, the most important question that we can ask ourselves in terms of outlooks, both for commodities and for public markets and any investor or producer in general. Economic cycles have natural tendencies. They have peaks and they have troughs and they have everything in between. I was just talking with an IMF official who used the word recession is inevitable, and it is. It's inevitable. Recessions are inevitable because they're an inherent part of the economic cycle. So that means that at some point we are going to see a recession. And this is something that behavioral economics dictates that if you look at the visual that I have here on the screen, we're just not accustomed to. So the majority of people living right now and working in the financial markets, we've enjoyed Goldilocks scenarios for the majority of our professional careers. So that is the base case scenario. That's our baseline. So we are not accustomed to recession or stagflation, which is quadrants 3 and 4 respectively. My view is that the markets previous to recent down volatility have been overestimating the perfect landing scenario. In fact, perfect landings and soft landings are historical anomalies. So it's important to keep that in mind. And at StoneX and on the institutional side, which is what I head up for research, what we've been advising our clients is to protect your positions. And my top pick this year has been gold, and it's done phenomenally well. In fact, what I've recommended is protecting risk exposure, whether it be because you're in long equities or whatever your risk exposure is, protect that for downside risk. And that downside risk can come from 2 different places. That can come from the possibility of recession, or it can come from the possibility of reflation. These are what we call in economics fat tail risks. So the tail risks are not the biggest probability, but they have a significant probability if we call them fat tail risks. And the 2 fat tail risks are so bipolar and so polar opposite in nature that to me, it just makes sense to be defensive. So yes, maintain your risk positions, but protect them with hedges. With, Josh Cannington is coming up, interest rate hedges, protect yourself, gold to protect yourself, cash to protect yourself, and put options to protect yourself. Just to give you a couple of visuals, we've never seen in the history of the past several decades an economy where we have leading indicators so negative for such an extended period of time, and we've never seen recession. This time is different is the most fatal words in economic analyses. I don't like them at all. Maybe this time is actually different, but probably it's not going to be different. Inflationary pressure is coming down. It's coming down from very high levels. So that's good. But let's remember that the target is 2%, and that's an average target. That's trend 2%. We're not there. We're at 2.8. And in fact, we're probably not going to get there in the current scenario where we have a Fed that's really juicing the markets. We saw the December Fed pivot, which was premature. And I said this to our institutional clients at that time. Declaring victory ahead of time and causing a loosening of financial conditions is inflationary. So let me go back to those two fat tail risks. One tail risk is recession, and recession can come from an increase in oil prices because the Strait of Hormuz is closed because of a war in the Middle East. A full closure of the Strait of Hormuz would add $40 to the price of oil. And if that's the case, that is stagflationary, which means it throws us into recession and inflation. So that's one fat tail risk. The other fat tail risk, and I'll refer to the slide here, is consumer confidence is so darn robust. And yesterday I was talking to the chief economist at the conference board. The conference board does this exact, actually, this is University of Michigan. University of Michigan versus the conference board, they both have confidence indexes. University of Michigan confidence is more attached to inflation, perceptions, and it's actually coming down. Consumer confidence has a high the conference board's metric of consumer confidence has a high correlation to the unemployment, to the labor market. So if the labor market's strong, consumer confidence is high. And in fact, consumer confidence is very high. And you can see that in the numbers. This is CPI. So remember, everyone, the Fed's target is not 2%-ish. It's 2%, trend 2%, which means you got to get numbers below 2% as well. So it's not, let's go from 2.8 to 2% and we're fine. We can go back up to 3. It doesn't matter. No, the trend is 2%. And last night I was having dinner with former Fed officials here in Washington, D.C. And one of them told me she spent 12 years working in the Fed for a governor. And what she told me is the Fed is married to its 2% target. The question is, how long does it take them to get there? And she thinks that they're willing to take some time to actually get there, but they are married to that 2% target. So what are the main drivers? That's what this visual shows you. I like to keep things as simple as possible. This is what this visual tells you. 1 percentage point of those 2.8%, which is inflation rate year on year, 2.8% growth in core PCE, 1 full percentage point comes from the housing market. 1.8 percentage points, the remainder of that 2.8%, comes from service sector inflation ex housing. So that tells us that guys and gals, we have jobs, our salaries are beating inflation, and so we're spending, and we're spending pretty strongly. I think housing sector inflation could come down and should come down. The issue, of course, is 30-year fixed mortgage rates remaining as high as they are. So that I think is a headwind to housing prices coming down. Were it not for a Fed that is going to have to keep rates higher because inflation is an issue, were it not for that and the Fed were able to cut rates, what we would likely see is a drop in housing prices because it would unlock supply. And the reason I say that is because most of us, 92% of us, have mortgage rates below 6%. And 30-year mortgage rates are, as you all know, well above that. Historically, there's a tight correlation between new tenant rent, which is collapsing, and housing prices with a lag of 4 months. So we probably are going to see some decline in housing prices, but I think it's going to be following this trend that you can clearly see here. But I do think it's going to be handicapped by the following. It's going to be handicapped by 30-year mortgage rates that are at 7%, when 92% of us have interest rates below 6%, and 2/3 of us have rates below 4%. So if you have a 4% rate locked in for 30 years, it makes you unlikely to want to sell your house, even if it's at a profit, having to lock in much higher rates. So what have we seen as a consequence? Housing prices are very high. This is the chart to the upper left-hand side. Blue line is on the left axis. That's home prices, and that's an absolute level. So what you can clearly see here is that we're at all-time highs in terms of national home index prices. The gray line is the right-hand side. That's the percent change year on year. So we saw a drop from 20% growth every month compared to the year prior. We saw that collapse to zero, which was actually one of my forecasts, because going into a year ago, I thought housing prices cannot continue at this current level. They're going to have to drop. We're probably going to see a 0% rate of growth. We hit the 0% rate of growth. Unfortunately for inflation, and unfortunately for the Fed, given that housing adds 1 full percentage point to that 2.8% inflation number, housing prices are starting to tick up again. And that's because of supply. My forecast for inflation this year is 2.6%. The budget deficit is, as an economist friend of mine here in IMF, she calls it the likes of a Stephen King novel. And it's a fun, colorful way of looking at it. But maybe it's not an exaggeration when you consider that the fiscal deficit in the United States is 6.5% of GDP. And we've never in the history of our country ever seen such pro-cyclical fiscal policy. What I mean by that is we've never seen fiscal deficits in this order of magnitude outside of recessions. In fact, I'll go even further, and I have a lovely chart on this, I believe, which is that the US economy is growing 1 full percentage point above its potential growth. That means we have a positive output gap, which is inflationary. So going back to those bifurcated risks, we have 2 fat tail risks. One is recession, and I can get into that as to why that might be induced, but it's a part of the economic cycle. The question is, when does it happen? And the other tail risk is an overheating. We have labor market. The labor market is very strong. We can debate the validity of the Bureau of Labor Statistics data, but the trend shows that the labor market is very strong, and we see consumption remaining robust. So what that could engender is a reacceleration in inflation, and the Fed will have to react to that. My suspicion is that the Fed does not hike again, but they could, in theory, hold rates all of this year and all of next year were that to be the case. What's the rub here? The rub is that we in the US, and again, I'm so happy to be the timing of this. Here at the IMF in DC, I've never heard so much concern with regard to the fiscal dynamics in the United States of America. So I'm getting this question a lot in my investor meetings. I just came back from New York, now I'm in DC. The question is, how does this end? And the reality of the situation is over the past year, interest payments as a percent of GDP have almost doubled, okay? And at the same time, we have term premia, which is the required interest rate that treasuries have to pay, moving higher. So what does that mean? We're paying more for interest payments. So right now, the current state of affairs in the United States of America is that we have to issue debt to pay for our debt. And that's a very unfortunate situation, especially when we're considering China's diversifying into gold. Gold has had a record rally. It's not because of inflation. Gold has had a record rally and has made record highs because central banks are diversifying away from the dollar. China's holding fewer US treasuries. Price insensitive buyers are buying fewer US treasuries. This couldn't come at a worse time. The Federal Reserve is buying, actually it's not buying, it's now letting their assets roll off. So that's also a difficult position for the US economy to be in. And what I'll add here is that I do not see a debt crisis because there is no substitute to the dollar or the treasury market. So China can buy fewer treasuries, but they're gonna have to still buy treasuries. So until there is a substitute to the dollar as the sovereign reserve currency of the world, I don't see a fiscal crisis. So what is the worst case scenario from a US economy that continues issuing $1 trillion or keeps adding $1 trillion to their deficit every single year? I'll tell you what it is. In my view, the biggest risk there is something called crowding out of the private sector. So the government becomes so big in terms of its necessities for financing that we get a private crowding out of the private sector. That elicits lower potential growth. That means the US economy grows less. And this handicaps future generations. And this is something that I just discussed yesterday with the Congressional Budget Office. The question posed to him was, what is the biggest risk here? And he answered exactly the same way: risk to future generations and lower growth. So it's not like we're going to get a blow up in the US Treasury market. It's not that China's going to start selling treasuries. It's just handicapping our future. Inflation expectations are rising. We have the 2-year inflation moving markedly higher. And here's a reference that I made earlier, which is the output gap. The US economy is growing above potential, which is fantastic, but not when inflation is also growing above potential. The good news here, and this also I was corroborated today, just today, in one of the meetings that I had on mortgage-backed securities and commercial mortgage-backed securities, which is that the IMF is not worried at all about residential real estate. And the reason is because of this chart. Because the US consumer, while jacking up their credit card debt in comparison to discretionary income, is not as levered as historically they have been. I'll keep this very simple. The Fed, the risk that the Fed cuts versus the Fed hikes is asymmetric, meaning that the risk of the Fed hiking is very low while the Fed wants to cut. So the risk of cutting is very, very high. When you look at past monetary policy cycles, the average, the plateau, which is the highest rate that the Fed has taken Fed funds to for the longest period of time, on average, is 8 months. And we're there right now. So if we go past 8 months, this will be a historical anomaly. I'll just get my view in here right now. I think that the Fed probably does cut this year. Do they have to cut? No, they do not have to cut. The Fed wants to cut. So the Fed is probably going to cut this year. My suspicion, and unfortunately, I was out of consensus expecting for June when Mark was expecting a May cut. Now I'm going to have to change my forecast, and I'm going to change it to September. I think they cut in September. They probably cut once. They might cut another time in December. So that would be September and December. As a result of high inflation, high interest rates, stock bond correlation is very, very positive, which means that both go up or both go down. In the fixed income market, people who have gone long duration have gotten killed because the Fed is not going to be cutting anytime soon. The 10-year Treasury, to me right now, looks like a buy. Fixed income does very well in recessions and in stagflationary environments. As you can see in quadrants 3 and 4, this is fixed income returns over time. And I think that we're probably going to see the beginning of a credit cycle, which means that you see emerging market debt default, you see leveraged loan debt default, and you'll see some commercial mortgage backs as well default. I'm sorry, I just skipped that. I'm just kind of going through this quickly because we have limited time, but investment strategies, in my view, from both public markets and commercial markets should be akin to where we are in the economic cycle or where you think we're going. And that's why I begin and end all of my presentations with where I think we are in the economic cycle and how asset classes react to that, to the economic cycle going forward. So equities, large cap, do terribly in recessions and stagflations, fantastically in Goldilocks. Equities are rich right now and overvalued. The dollar is going to stay strong. The dollar is going to stay strong this year. And the dollar is going to stay strong because the Fed is not going to cut as much as expected. And probably Europe cuts rates sooner than we do. But in structural terms, the dollar is overvalued. Fiscal deficits and current account deficits generally should influence a currency. But when your currency is the sovereign reserve currency of the world and you have the risk-free asset, sometimes that doesn't play out. There was a lot of talk about China here in Washington, D.C. at the IMF meetings. Happy to talk about it a little bit in the future, or if we have time for Q&A, Cassie. But I'll tell you what, I mean, the vibe here on China is exceedingly dismal, exceedingly dismal. The real estate market is the biggest point of concern. There's talk of China wanting to harness economic growth from the external front, which would be an effectively exporting deflation. Commodities are robust. Energy, the view is that energy is going to keep moving higher. My forecast was for $82 a barrel by year end. As I put here, geopolitical risks are very clutch to that. Changes in oil price have important repercussions for both inflation and economic growth, which you can see in this presentation, and you are welcome to review this more in depth a little more in the future. But the point here is that an oil price shock is both inflationary and recessionary. So that's what we call stagflation. And that with that, copper, I think of all the industrial metals, I'm most positive on copper due to supply and demand dynamics. And with that, Cassie, I think I'm at my time, and I would be very happy to take any questions that we have.
Kathryn, I don't see any questions coming through at this time, but really appreciate your valuable insights in all of this. I think we can go ahead and move on to Josh Cannington on interest rates. And thank you again, Kathryn.
Thank you.
Yeah, thanks, Kathryn. That's fascinating. I bet you're learning a lot up there in New York and meeting all those people. So getting right into it, man, the interest rate market has been on a tear lately. 2-year yields button up against 5%. We saw them try to test that level yesterday following Powell's comments. 10-year now at 460, basically the 5.710. Everything out past the belly of the curve is basically trading around 460 to 470 at this point. And it's pretty crazy to think about, that we started this year with the 10-year with a 3 handle, right? The 2-year down closer to 415. And we've only seen a rise since then. So for Fed funds, really unchanged. As long as policy's on hold here, we're not really going to see any movements in the repo market. So that keeps SOFR pegged around 530. Here's your fun fact of the day, Kathryn. We're coming up on our 2-year anniversary of an inverted yield curve. So we've officially eclipsed the 1978 cycle, and we've been inverted for over 18 months now. So it's one of those, yes, classic recession warnings, but it's been the longest breath hold for that recession that we've seen for, call it 50 years. And looking at how we've been trading this year, it's really been range bound. The volatility that we were kind of used to last year was quickly faded in Q1. You think about what's really been driving markets. It's been, yes, sticky inflation reports, but there's been push and pull, deeply in those reports. Core inflation showing a little improvements here and there. But really, if you dig down to it, a bullish case can get pulled from it, a bearish case can get pulled from it. And so in the labor market's generally the same way, where we get strong readings on monthly jobs, but then the previous 2 months gets revised lower. You see, marginal increases and decreases to unemployment, and wages still staying strong, but maybe showing, a direction lower. So again, from the beginning of this year, it's been the story of sticky inflation, but nuanced underneath the surface. Labor market, nuanced below the surface. And that push and pull has kept us with, loosely range bound across the curve. And then you look at what the Fed's been doing, absorbing all of these reports, absorbing all this information, and just digging their feet into the sand. You look at like the March dot plot. If there was ever a time to turn hawkish, it would have been at the March dot plot, because January, February inflation surprised to the upside. They were showing not necessarily a lack of progress, but definitely a slowing of progress. And they kept to their guns and said, you know what, the median dot, we still think roughly 3 cuts this year. Between all of those pushes and pulls, we really didn't see a breakout until early this month. And where that complacency about, we see disinflation and a month behind us, it's going to continue. Yeah, jobs are good, a little mixed picture there, and that's just going to continue. And the Fed thinks we're going to cut three times this year. All said and done, that leads to a very low volatility rate market. But you look at the April 5th job report came out, 303,000 jobs, previous two months revised higher, 3.8 unemployment, wages still stuck at a 4% annualized clip. And that really shook up, the kind of the neat, clean box that markets had painted for this year, and really questioned how long can the Fed stick to the three-cut narrative. And that broke us out to the upside. And then the following week, we got CPI. And that was the nail in the coffin that, the past is not indicative of future events. CPI, once again, surprised for the third month in a row to the upside. Core inflation stopped improving, and CPI went up from 3.2 to 3.5. And then it was off to the races. And it was just a selling bloodbath since then. The 2-year, again, it's kind of scraping across 5%. The 10-year is on a march higher and maybe looking at 4.75 if we just see a continuation of the data. And you look at that, compared to where treasury yields are trading versus what the market's expectation of rate cuts are this year, kind of tells you a picture that maybe the front end is going to struggle to move much higher from here. The long end definitely does have some room to move higher. And it kind of goes back to you chew on the question of how do we get the yield curve to uninvert? And for so long, it's just been assumed that the front end would collapse on rate cuts. And that's how we get back to a positive sloping yield curve. But now, I guess if the Fed just keeps on holding from here, maybe it's the long end that sells off so much and flattens out the curve again. But time will tell. And, it's a pretty interesting point in time where you look at back when yields were across the curve were at 5%, and how they were expecting the cutting cycle to look versus today, how they expect that cutting cycle to look. The curve is actually more hawkish today than it was back in October of 23, and way more hawkish than that March dot plot that the Fed showed us. But again, I think that March dot plot is a bit stale, especially given Powell's comments yesterday, and really kind of walking back his confidence on inflation moving towards his target. So how do we get to 5%? Quite honestly, it might be just a continuation of the data. If we still see inflation surprising to the upside, you see inflation expectations. Powell always speaks about inflation expectations being a kind of a center of gravity for longer term inflation performance. Those are surprising to the upside. As long as the labor market's strong, no reason to cut. And eventually, come that June meeting when we get the dot plot revisions, I would not be surprised if we see some capitulation on those 3 cuts that they want to see, and they start walking those back. So we're marching higher on the long end. I'm looking at 4.75 to see if we can break through that next. But again, Kathryn, to your point, there's tail risks everywhere. Geopolitical risks are probably, front and center for a lot of people, especially markets. Israel, Ukraine, you name it. But just below the surface, I'm glad you touched on it. Bank balance sheets. Deposits are not cheap. Cash is an asset class again. Loan growth is macroeconomically pretty lackluster. So, banks are struggling in this high rate environment. You talk about office CRE concentrations in the loan book. Those type of tail risks can materialize kind of quick and overnight. So those are the kind of the downside flight to safety risks that we're kind of paying attention to as well. And then trying to get granular here, what exactly is baked into the curve today versus Jan 2024? We went from over 6 cuts baked in for this year down to less than 2. There's less than 2 cuts currently baked into swap rates. The first one at that September meeting. So Kathryn, you might call it perfect. And then the second one, not until January of next year. So it's a pretty hawkish curve to say the least. The market probably is getting it right this time around, and the Fed is probably going to have to bend the knee to the markets and start walking back those rate cut expectations, especially if there's no weakness in the labor market and inflation is sticky. Again, I go back to what is the economic necessity to cut rates if the economy is doing just fine. Yeah, to that point, look at retail sales. Just last week came in twice as higher than expectations, despite the fastest rise in monetary policy since the 80s. So to talk about inflation, again, it's going to be the elephant in the room. And this super core CPI metric was really the big takeaway. from the report earlier this month. That is, if you strip away the noise of the housing market, strip away the noise of gasoline prices keeping headline CPI at 3.5%. This is a kind of a way that the Fed looked at how much attrition and how much filtering of demand from the labor market is showing up in pricing pressures. So services inflation, ex housing, call it super core, kind of love that name, is accelerating. And it's showing it, I don't think there's any coincidence that following that late 2023 pivot and 100 basis point rally in the bond market, that demand inflation picked up. If I could just speak freely here, I think this last CPI report has Powell's name written all over it, right? So it almost felt like he wanted to socialize interest rate cuts into the marketplace before it got politicized this year. And he did it a little bit too early. The bond market rallied 100 and some basis points, and demand inflation came right back around. And here it is showing up in the 3-month annualized trend. Inflation is moving away from that 2% target at this point. And, again, back to that late last year pivot is almost like a mini policy mistake in my mind. And I don't think there's any coincidence that when rates fell on the long end of the curve late last year, that you saw corporate bond issuance, new issue supply hit 2-year highs, right? So Fed raising Fed funds, that keeps floating rates expensive. But when you see long-term fixed rates fall, well, then who cares about 530 Fed funds when you can go and borrow at 4% again? And when you had that stimulative approach in the long end of the curve, demand inflation picks up, and that's exactly what we're seeing. And I think trying to get out ahead of that November kind of, timing is tough this year, right? As far as how do you layer in the first cut? You have the November election kind of out there looming, but you still want to look kind of apolitical. You still want to be independent, and that's pretty tough for Powell right now. And it looks like he went to that. He tried to get out in front of that a bit too early, and now he's kind of shooting himself in the foot, kind of early this year. Kathryn, I find myself looking at a rate cut, maybe July and September as well. Again, I don't necessarily think there's an economic necessity to cut. Inflation stuck at 3.5%. We're kind of, 3.8 unemployment. We've had sub 4% unemployment for the last 2 years. We're seeing 200, 250, 300,000 jobs being added to the economy every month. And now we have easy financial conditions. Those financial condition indexes are as easy as they've been since Fed funds was at 3.5%. So again, why cut, right? So why dig into those 3 cuts? Why lead the markets into believing that the only path forward is rate cuts? And I think that November is just kind of front and center for Powell. If you caught his comments at Stanford, he had an entire paragraph dedicated to explaining how independent the Fed is from politics, and how they're just calling balls and strikes on the economy as they see them. And he's almost saying the quiet part out loud. He wants to get cuts out in front of the market early to get away from that November political situation. So, the only reason, and maybe the only credible way I can back into understanding why they would want to cut or how they can lean into a cut from an academic standpoint, is maybe they want to just keep real rates, a quantitative way to look at how restrictive rates are. Maybe they want to keep it around 2.5%. If we can see core PCE kind of meander 20, 30 basis points from here out in July, there's a lot of time between now and July, September. We get 2.5% core CPI. You get real rates kind of closer to that 2.8 level. The doors open to cut 25 and still maintain 2.5% real rates. So taking all that in, right? How do you apply that to the real world? Managing debt from a business perspective. Hedging strategy is still great to look at. Everything you look at is still trading in the money day one. Some of that positive carry is starting to leak out of the market, but they're still there. But I think I'm coming off my time. So if you're going to look at hedging strategies, I would do a couple things. You don't have to pay 530 SOFR if you don't want to, but maybe hedge conservatively here. Try to aim for that 50-50 mix of fixed versus floating, and be patient for a pullback. Whenever we see these large pickups and these large moves in the rate market, in the months to come, sometimes they get they get unwound a bit. Look at a layering in approach, right? Take advantage of big rallies, especially if come July, September, they cut and we see a Santa Claus rally V2, a Christmas in July, if you will. Take advantage of that. You know, I'm not a buyer of one cut leads to 2, into 3, into 4. You know, it's probably a one cut and then, hey, let's take a break here and see what happens next. AKA, let's see what kind of fiscal stimulus we see post-election before making another cut or another change to policy. So maybe this summer, take a look at rates. I like the front end of the curve, 2 to 3 year tenors, even 4 years. That's a good balance of risk and reward, right? So there's still good savings over spot SOFR, trading deep in the money day one. But out past that, 5, 7, 10-year rates are really just trading right on top of each other. So you're really not picking up a bunch of savings, and all you're really doing is adding in some liquidity risk, a lot of mark-to-market risk. So for what it's worth, stay on the front end of the curve if you can. Outside of that vanilla playbook, man, I like the options used here. So look at costless collars, 3 years, 475, 440. That floor is trading in the 3s for a little bit there. So if you wanted to watch something, watch that costless collar floor in the 3 year. Picking up roughly 60 basis points day one, that's meaningful, and you participate in the cutting cycle down to the Fed cuts 4 times. Yeah. And then again, you know, the last thing I'll touch on here is swap rates and covered calls. You know, that's probably my favorite thing to look at right now. You know, caps used to be worthless to look at when the curve was extremely downward sloping. Not anymore. Those have some serious value to them. So again, I think you're looking at swap rates. Consider selling the covered call because a hawkish move for the Fed is probably not a hike. Again, 250 real rates gives them some cushion to absorb some sticky inflation, maybe even a little bit higher inflation. Hikes are generally off the table at this point. A hawkish move for the Fed is more of a hold. So sell the covered call and pick up the same floor as that collar, but change into a fixed rate where you improve the positive carry day one, but still participate in the same cutting cycle that you would with the collar.
All right. Over to you, Dan. Thanks, Josh.
Thanks, Cassie. Appreciate it. Hang on, let me just set my timer here. So I think what I want to talk about, we only have 15 minutes today, but a lot of you are familiar with those dashboards we have. They're 16 variables. And in any market, interest rates, energies, grains, there's a lot of moving pieces that are driving markets. And just like when you're 30,000 foot level today, we're going to take a look at what you can see. And what I'm trying to do here is look at the top 3 drivers in the oil markets, top 3 drivers in the natural gas market, and keep all those other factors are tied into that. But in our estimation, as we move into Q2, Q3, and Q4, these are the 3 big drivers that we see right now. In the oil markets in particular, number 1 is world supply. And if you think about world supply, you're really talking about 3 or 4 major suppliers. So I always look at world supply numbers as pretty concrete. It's current. It's what's happening right now. We know what supply is. We know OPEC's cut. We know what Russia's cuts are. They may be tweaking and cheating, but for the most part, we know world supply. You move into world demand, you've got 3 or 4 major demand forecast groups among OPEC, IEA, EIA, and they're varied, as you're going to see. Those demand forecasts are not as concrete. They're kind of forward-looking, but they are concrete forecasts. They're just not certain because you have so much diversity, as Kathryn was saying, between China, U.S., Europe, emerging markets. And then you've got the number 3, which is world hotspots. That's the wild card, which we think we know where potential risk factors are, but we really don't. And I'll talk about that as well. If we look at the 3 factors in terms of world supply first, I know Norway, I know there's Venezuela, there's issues with their sanctions, but when you think about the 3 big suppliers, OPEC cuts, they talked the market down. They've been doing a good job. Russia, OPEC Plus now, is also stayed compliant for the most part with their production cuts. And even the U.S., the rig count drops that we've seen, hasn't factored into oil as much as it has necessarily production cut in gas. But what it's done is it's at least reduced by a couple 100,000 barrels a day the U.S. growth that was expected. So when you think about world oil supply, think of it as it's a snapshot right now. The market has all three major suppliers effectively reducing or stabilizing production. That's an underlying current of bullishness for the oil market. Just basic. That's what we know right now. When we think about demand, it's interesting. I brought this up because I was interested in seeing, and I thought this would be the case, but EIA is the U.S. Department of Energy. Their world oil demand growth forecast is about 900,000 barrels a day in 24, 1.1 million barrels a day in 25. Then you go to the International Energy Agency. They're obviously more of a think tank. Their forecast for demand is 1.2 million barrels a day in 24, 1.1 million barrels a day in 25. And then what's most interesting to me is OPEC, who is a major producer, also generates a monthly report on oil demand. And as you would expect, their oil demand growth is 2.25 million barrels a day in 24 and 1.85 million barrels a day in 25. Think about that for a minute. The spread between the highest and lowest estimates for 24 is over 1.3 million barrels a day. And those numbers change when they come out with their forecast monthly or quarterly. So you've got these concrete supply numbers, which are pretty much where we are right now. And then you've got these world oil demand growth forecasts, which move from a more conservative approach in the U.S. forecast to, let's say, a more Pollyannish forecast by OPEC. But the market trades off of these. So if we cut demand growth in any one of those three forecasts, or we increase demand growth, that's where we are. Now, what's been happening over the course of the last couple of months is demand growth forecasts have been ratcheting down. So that's a little bit of softness, which is why the oil market, on one hand, is tight, but the concern about weakening demand on, as Kathryn and even Josh was talking about, interest rates, contracting markets, that we have this tightness that's probably going to potentially hurt demand over time. So we need to watch those forecasts that come out. Think of that as a medium-term market mover that we see. The third piece is these hotspots around the world. And there's three hotspots that we're very familiar with. And you can look at Russia, Ukraine going on 2 years. You can look at China, Taiwan. On one hand, you've got Russia, Ukraine. I'm not saying the market is looking past that conflict, but it's become bogged down in that conflict and its effects on energy. On the other side, you have China, Taiwan, which is the variable that could dramatically shock the markets because of China's issues of bringing back Taiwan, the response by the U.S. and Europe, all those factors that are potentially a bigger risk, especially as we're in an election year. And then you've got the Middle East in the middle. And the Middle East by far is the biggest circle. I would say, and this is just my opinion, but the Middle East response after the Iran bombings of Israel shows the Middle East countries, I think, I'm not condoning anything they do, but they seem to be more business-like than they've ever been, where they want stability in oil prices. I don't think they want oil prices to go to $110 or $120. Great short-term gains for them, but in the long term, it effectively brings out more production from these other parts of producers around the world. So I think the Middle East is restrained for the first time compared to past conflicts. Now we'll have to see the response that Israel is going to have over the next week. It seems like there's something there. As far as China, Taiwan, that's a wild card. We just have to be there. And I think the market's ignoring the impact of Russia and Ukraine. When you look at the damage done by both of those bombings of drones and missiles over the last 4 to 6 weeks, Ukraine's electric generation system at one point was 60% damaged and is significantly reduced in terms of what they can produce from an electrical standpoint because of the bombings. At the same time, Ukraine's been bombing the refining capacity in Russia, and that's hurt them. Where at one point, I think it was 700,000 or 800,000 gallons a day of refining capacity that were damaged. Now they brought some of that back online. So these hotspots, when you think about a big picture where we are, those hotspots are there, and we have to be. Let me turn this off. Sorry. And we have to be aware of that. But that's something that we can't really put a finger on and say, boy, the next thing is going to be Venezuela. The next thing is going to be somewhere else. Is it going to be India? Is it going to be Pakistan? We don't know that, but we're always obviously aware of that. So you've got this broad macro sense of underlying support overall for the oil markets. And you can see oil prices in general, crude oil prices have been in a range of roughly $70 to $90 for most of the last year, 14 months, at the higher end of the range now. I think you're all familiar with this. It's our value matrix for your history. You want to be buying or hedging exposure at the bottom end of when we're under that median value, which right now is about $76, $77. So that's a nice picture of where it gives us an idea of what's value for us. And that's great. We've got this macro sense of underlying support for the oil market. We've got targets for where value is, but we do need to be aware, and I've had a lot of people ask questions on our dashboard, and I want to be pretty clear on this. You've got a lot of moving pieces on any of our market dashboards, and our dashboards are utilized for short-term market outlook. You're not going to go out and hedge heating oil for 26 based on heating oil or crude oil dashboard being bullish or bearish, because these factors are what we see now. OPEC production is still bullish. U.S. production is down. All these different pieces come together, and they allow us to have a snapshot of where the market factors in right now for a viewpoint. So if I'm thinking about, I'm in value, I have to hedge, do I wait? Well, that dashboard helps us with very bearish to very bullish. And a lot of times you're going to find these dashboards are right on the edge of flat, which is what markets tend to do. They tend to be consolidation, boom, move out of somewhere. So from an oil standpoint, keep in mind, macro sense bullish, value not there right now for oil. When you think about it, value prices on oil are effectively in the 60th and 70th deciles, and the dashboard's bearish. So do you have to be super aggressive on hedging? Not necessarily. Should you be cognizant of when the market hits value? Absolutely. And keep an eye on the dashboard, because this underlying driver in the market of a tight supply market, demand forecasts, which probably are going to ratchet up again in the next quarter, just because of the stubbornness of the U.S. economy, especially. We're probably going to see that market be supportive on breaks. If we look at gas markets, let's zoom out the 30,000-foot look and look at the three main drivers. And I know people are going to talk about storage. They're going to talk about consumption. They're going to look at variables like what's going on in Europe. Well, they all tie together in a way. And I think from a natural gas standpoint, we've got U.S. production, we've got LNG, and we've got weather. And U.S. production is pretty amazing. And I'm not going to spend a lot of time on this because I think a picture is worth 1,000 words. Before I look at the top graph, which is production for this, what we've gone over the last year, I think it's really important to look at that bottom graph from the EIA. We had production growth year over year from 21 to 22 and from 22 to 23 of over 5 BCF a day. That's huge. That's huge. Where would gas prices be from an inflationary standpoint over the last 2 years if that was more in the 2 or 3? I don't even want to think about it from a standpoint, but that production growth was there. Something interesting is production growth is down at about a half a BCF drop this year because producers are finally becoming fiscally responsible. And as I said, sub $2 prices are not economical. Production's expected to drop. You can see we're down roughly about 8 or 9% production. I don't think that production is going to come back. Everybody says, well, it's factored into the market. I disagree. I think that production cut's going to stay around. And we're in such shoulder month demand that it's being kind of mirrored in the background because we don't have a lot of weather demand for cooling or heating right now. We've had LNG facilities down. So that is being muted. But I think that production is an underlying very bullish factor for gas on its own. When you look at LNG, you've had some major repairs or whatever you want to look at that have been happening. And from that standpoint, we've had LNG drop to under 10 BCF, which is under the 3-year average. It's amazing that we've seen that. I mean, that's been something that we haven't seen in a long time. And At the same time, we're at about 13, 14 BCF. Our growth is going to be roughly about 75% growth over the next 4 years. And I think that's realistic. The Biden administration is expecting to do that pause by the end of the year and review. Those projects are likely that are in the pipeline, and you can kind of see down here of another 10 BCF, are going to come to fruition to some degree. So LNG markets and growth in U.S. gas demand is going to be there. And one thing about Europe, I don't know if you noticed European prices, they've moved higher and higher quickly percentage-wise, while our U.S. markets have been more flatline. That was very similar to 2020 when the coming out of COVID, you had the TTF prices move at about a 2 or 3 month head start to U.S. prices turning around and going up. And finally, we've got weather. And weather, our normal withdrawals in winter is about 2,100 BCF of gas. We withdrew roughly, if you think about winter being over, 1,600 BCF. That's 500 BCF less than we normally draw. That's why gas prices are at $1.70, $1.80. It's like turning over, and now we've got a new ball game on a doubleheader. This is the summer weather we're in, and the forecasts are hot. La Nina brings ridges to North America, especially the United States, and the middle part of the country and the East Coast. We'll have to see how long and how temperate those ridges are, but the forecast is there. And when you think about gas demand, it's about 42% last year, even with solar increases, 6% this year, 7% next year. Wind is picking up where total they're 22, 23%, 24% of total generation on wind and solar. Gas is staying around. You saw the Buffett utilities, you saw Duke. This is in the last 48 hours, both talk about we need new gas-fired generation being built to make up for those gaps that the renewables can't do. So gas is going to be around.
So when we look at that, we've got our dashboard, which is definitely in value, and I don't need to spend time on that. We've been in value for the given over a year now in terms of that market. And as far as where our dashboard is, we're looking at a bearish near-term look on gas. There's no doubt about it. We're in a shoulder month. Think about gas from a standpoint of the macro situation, maybe not as tight or as supportive as the oil markets, but overall, still pretty strong from that market standpoint. If we think about energy, and I'll leave you with two charts. You've seen this chart before. It's one of my favorite charts that we look at. It's the commodity cycle in theory. We start with supply demand, trigger tightens, we have a trend change, we move into a new paradigm, and we start a capitulation, and then that starts over again. StoneX has multiple interesting sub-trackers that they do in energies and grains and softs and metals. And this is their sub-tracker of energy. And it basically is an index of all the energy commodities. What I did, which I thought was really interesting, is the last 4-year cycle from 2016 to 2020, you'll see the index here from 100 to 300. Ultimately, we pretty much tracked what I made this line up as just an example of a chart. And we saw that deep trough that happened in 2020. If you look at 2020 to 2024, you see a pretty similar pattern, but again, one big difference, and we've had clients ask that trough in gas over, this is energy, this is crude, this is natural gas, it's propane, it's diesel, it's gasoline, so you don't see the deepness of the trough that maybe you see in natural gas. But one of the reasons that we feel this cycle is about to start again, and it's not a cycle where we go to $10 energy, $10 gas, or $120 crude, but it's a cycle where the market starts to move higher. Is the first two speakers, what were they talking about? Inflation or stagflation. And when you have that around for an extended period of time, that tends to be positive for commodities over a longer period of time. So with that, I'll turn it over to Craig on the grains.
All right. Well, thanks very much, Dan. Let's go on over here to the grain and the oilseed markets. We did get some questions in on the Q&A, and I will address them and walk through those as we go through the presentation here. So we'll start with corn here, which actually is where the two questions have come from. And one of the things I do want to point out here is just manage money. We are short right now. The funds are still short, not as short as they were a couple of months ago, but they have driven prices down into the $4 range here. What is interesting to note, I went and looked at all the net short positions for managed money since the 2012 drought, and I can only find 1 year where they stayed short the entire growing season. So that's interesting. We'll see if that continues. But what we may find here is that you do see some kind of short covering rally, and that would actually be consistent with the seasonality of some of these. What I also find interesting too is when the funds got record short. The reason why I circled those 2 points, back in 2020, when we got record short, prices were around close to $3, and we got record short this time around, 4 years later, after about 15 to 20% inflation, which has definitely been a theme today. The record was closer to $4. I mean, the prices were closer to $4, and we've been talking about what exactly is going to be the new lows when we go from tight to adequate to burdensome stock levels post COVID. And maybe we're thinking here corn is likely a $4 to $5 market when it's doing a normal trading range, as opposed to the old $3.50 to $4.25 that existed back from, let's say, 2007 through 2020. So we'll move on here. And here's another chart of this. It's $4 corn, the new $3.30. I like using this chart a lot as of late because we've been talking about, is there going to be a new price shift for some of these markets? You can see in the left there, we've got the 60s when corn traded between $1 and $2 for the most part. You can see the effect that inflation had, in the 70s. We hear about these stories, but just to see it on a chart and how corn went from basically a $1.50 to $4 market from the mid 70s until 2007. Something significant, very significant happened in the corn market in 2006, 2007, and that was renewable fuels. And having to go from producing 11 billion bushels to 15 billion bushels a year severely changed how the corn market was going to look for acres. And when we shifted into a new range there. What is interesting, that yellow area with that new trend line around $4, if you take 15 to, let's say, 20% inflation from from basically the renewable fuel standard ethanol era, and you add that into the post-COVID inflation era, your lows of 330 start to price into about $4. And when the funds got record short and everyone was thinking we're going to have a 2.5 billion carryout for old crop and maybe 3 billion for new crop, which would be a stock to usage that we had not seen since before ethanol, we hit $4. So it's just something to keep in mind when we work with our clients on the buy side, and we're creating strategies. And sometimes when we use collars, particularly, that $4 and that $4 range for the bottom side of the collar, or the short side of the collar, probably makes a whole lot of sense now. While 5 years ago, probably wouldn't have. So I think that's a very interesting development here in the corn market. And just to back that up, U.S. corn stocks, this is for old crop. We will see next month this is leading up until old crop. Next month, the USDA will release their May WASDE. May WASDE is a big one because that's the first time you get to see those new crop numbers. At a 15% stock to usage, back in 2015, 16, 17, 18, 19, would have meant 350 corn right around now. Definitely in the mid threes, and a harvest low of like 330. 320, something like that. And here we are, we're certainly 15 to 20% higher than we would have been. So that's an interesting note on just the corn stocks here. As far as major exporters, we had a big low in 2020, just like we had in 2012, but we've recovered. So what the market is telling us is we are adequately supplied on the major exporter level, and we are adequately to almost burdensomely supplied on the US level. And here we are in the fours. New crop is trading for 460s, 470s. Old crop is trading 430s. Again, 5-6 years ago, that would have been 410, 420 for new crop, and 350 or 360 for old crop. We have been getting some questions here. I'm going to address those now. This is our balance. These are my balance sheets, and that green column is the USDA. That's from the latest WASDE. That A, B, and C on the right there, Those are just my estimates based on acres and acres and yields, and what could possibly happen in with certain scenarios. That B column is the most likely to happen, the 91 million acre planted, a trend line yield. We still have about 2.5 billion on the carryout in that estimate. We're still building 300 million bushels. So to me, this means corn is range bound. If we are at 89 million acres and let's say a 177 yield, which would be 4 off the pace and would match last year, and I'll make an argument, planting progress, soil, and conditions are going to be better starting this year than it did last year. We're still at a 1.8 billion carryout, 12% stocks usage. That is not a shortage for corn. Maybe we're a little elevated. Maybe we're on the higher side of that $4 to $5 range. We had a question here, if China, if Brazil has a 130 million metric ton crop, which means it would increase, maybe our ending stocks go up 100 million, but it's not a major, according to the USDA, it wouldn't be a huge move, because I think we're at a 124, 126. So a 4 to 6 million metric ton increase in Brazil production probably only means 100 to 200 million bushels of, that finds its way back onto the export market, and only 100 usually would come back to the U.S. As far as what does it take in terms of low prices cure low prices, like what does it take to get corn to stabilize here and not build year over year? Well, just to be at a 2 billion carryout and not increase production year over year, we got to be at 88 million acres and a trend line yield. So we still have to come down on acres. To get tight again, which is 1.5 billion and a 10% stocks usage with a trend line yield, acres have to go to 84 to 85 million, which seems unrealistic at the moment, unless prices keep on going lower. So that is our state of the corn here. For the buyers out there, my favorite old crop idea at the moment is just looking at straddles, and whether that be something like this where we're using $4 to the downside and 5 to the up, and hopefully we're going to be looking at pricing in between there. It is something, this would be an example of things you could do. You could also do something like this with the new crop. If we wanted to adjust it, we could adjust these prices for December, but you're just looking at the balance sheets. It's just at the moment, it just doesn't seem like $4. We would have to have very, very good yields and good to excellent ratings. And I would think just based on historic and value there, anyone would be happy to be a buyer at 4. The real risk is if we are talking a 175 or lower yield, or even we would go to $5. And if we go to 170 on the yield, all of a sudden we are tight and we are talking 550 or higher. So that's the real risk for the corn buyer right now. A 5% reduction in yields would really put it to the upside. But right now, that's not the way it's looking, but it certainly can happen. And if for any farmers on here that need, that are looking at this and wondering what they can do, there is a lot of carry left to go in the December crop. This is something I'm happy to talk to about anybody, but right now full carry in corn is 11 cents. We usually get to about 8 or 9 when we have ending stocks like that. So we're projecting. So that would be an interesting thing for the farmer side. As far as wheat goes, managed money is still very short. Not as short as it has been. And the reason why for that is while U.S. ending stocks are high here, and the United States is the supplier of basically last resort to the wheat market, the major exporters here are still very tight. So it does keep a little bit of an elevated price, and it prevents the shorts, the funds, from getting record short. So that's what we're seeing in the wheat market. What's really interesting about the wheat market is the classes. Now, we won't see a class breakdown by the USDA until usually the June or July. WASDA definitely won't be in the May. They'll just give us an all wheat. But when they do break this down, what we're going to see is this bottom one here in orange, that's soft red winter wheat. That's the Chicago contract. 25% stocks usage is tight. And then if we're only going to have 6.25 million acres planted based on the last planting intentions report and seedings report from the USDA, that's going to be even lower. So while overall there may be enough wheat to go around, this Chicago contract could get very short. And you can see the spreads maybe improve in their favor. So that's something to keep in mind, especially if you're a buyer of that soft red winter wheat contract. And here we go. What can happen on the wheat market? We're still, if we have 47.5 million acres and a trend line yield, we have plenty of wheat. We've got a nice stock to usage here. Things look pretty good. What we do have to keep an eye on wheat is if we do have weather issues, if there are production issues, if we have any kind of drought in the, let's say, the Western Plains, where yield gets to 46 or 44, then wheat starts getting tight again. And instead of being in the 5 and 6s, we could be 6, 7s, maybe even 8. I do think 8. You got to remember though, at 8, it does pencil to import wheat from Europe into the United States, and that's usually a rally killer if we should get back up there. So again, same kind of thing with with wheat here. You do have a lot of support at 540. This is the Chicago wheat contract. It's with 25% stocks usage and the lowest number of acres that I can remember now for Chicago wheat. The risk is to the upside for the buyer. You may want to take a look into the collars. As far as soybeans go and soybean oil, funds are not, the funds are short. Look at this. They're fairly, short down here, yet prices are still elevated, which is interesting because you got, what changed the grain markets back in 2007 so radically was ethanol. And now we're having, advanced biofuels kind of taken over from the ethanol trend. And that's much more concentrated on soybeans and canola. So what is that going to mean, for demand and pricing? And that's going to be something to keep a pretty close eye on. Soybean stocks are getting better. So, when we were down here at 6% stocks usage, this is beans in the teens area at an 8% or 9 or 10%. It's more of a $10 to $11 trading range. So something to keep in mind when the WASDE releases their next report in May. We're expecting new crop to be in between this 8% and 10% stocks usage, which would imply new crop should also be between that $10 and $12 range. As far as the exporters go, exporter stocks are increasing. Still a little tight, but they're getting better again, and that's going to be a some downward effects on soybeans, on soybean oil, and on soybean meal. And then finally, just with the with the tightness, we are looking here on the balance sheets to increase old crop stock to usage. 8% is adequate to tight, but if we have 87.5 million acres and a 52 yield, we could be at a 400 carryout. What that implies is soybean oil probably trades in the 40-cent range for a while until renewable biodiesel really picks up. We will have some new information on the GREET model and how much that's going to impact basically the how much that's going to impact the demand for, let's say, vegetable oil over corn. When that number comes out, we'll have much better idea of how much the crush is going to increase and how much bean oil and canola oil is going to be used for things like sustainable aviation fuel and anything else that has to do with advanced biofuels. But the lobbyists in Washington now are really trying to duking it out between corn and vegetable oil on what exactly qualifies as an advanced biofuel versus just a regular biofuel, which is really the corn versus soybean oil fight right now, and a couple other things. So once they sort that out, we'll know what the models are, but still a little too early to kind of get a handle on where we think soybean oil is going to range. For the moment, it's going to be most likely in that 40 cent area, 40 to 50 cent area. And finally, when the markets really do, this is my last slide here, and then I'll pass it on to Nate. But what everyone needs to remember here is, when we account for inflation, and if we start with corn, which is usually the most planted crop here in the United States, so we base the price ratios off corn. When corn is an adequately supplied market, it implies a price at the moment of $4 using a linear regression model with supply and demand and taking into account inflation. when we take the historical price relationships and apply that to Chicago wheat, Kansas City wheat, Minneapolis wheat, and soybeans, we get wheat, lows in the low to mid fives. We get the Minneapolis wheat in the mid fives to really around $6, and soybeans around 10. Now remember when soybeans were very heavy, and this was before COVID, we were trading like 880. You add 15 to 20% to that price, and we're closer to 10. So that is, kind of what we're, we were talking a little bit about where do we see kind of value and lows just based on historical stocks usage and pricing, where we'd be comfortable really buying farther out in the curve or using option strategies, as kind of set in floors, for buys or min-max contracts. And this is kind of the areas that we'd be looking at. So if you have any further questions, please throw them in the chat. I'll get back to you afterwards, and I will pass this on to Nate.
Thank you, Craig. My name is Nate Donnet. I'm Director of Dairy Market Insight here at StoneX. The major new development that we've had, and a big point of discussion over the past month, has been the detection of avian influenza in the dairy cow herd. It started in the Texas Panhandle back in February. It's now been confirmed by the USDA in 8 states across 26 different farms. But in our discussions with people in the industry, the feeling is that the number of farms actually infected is probably closer to 100. When a farm gets infected, about 10 to 15% of the cows, and these have, as far as I'm aware, all been mid to late lactation cows, start to or end up showing significant symptoms, primarily reduced feed intake, and the milk production really drops off, and it becomes a very thick yellowish milk. But most of the cows recover in 7 to 21 days. It's kind of like the flu in humans. A few of the cows, about 10% of the sick cows, so 1.5% of the total dairy farm milking herd, ends up drying off a little bit early due to the reduced feed intake, and some of those animals are being sent off to slaughter. The concern now is with birds migrating north, is this going to spread more widely in the northern tier of states? Most of the cases so far have been down in the Texas Panhandle and New Mexico, but we are seeing cases develop in other parts of the country. At least the cases in Idaho, Ohio, and Michigan can be traced back to moving cattle from Texas or New Mexico into those states. It isn't clear yet how much of the spread is happening due to wild birds spreading the disease. Anecdotally, from the farms that have been infected, they end up seeing about a 20% reduction in milk production for roughly 2 weeks. That's a significant hit in the short term, but when the cows bounce back, and most of them bounce back, and you look at this on an annual basis, it's only about a 1% reduction in milk production for that particular farm. There's about 26,000 dairy farms across the US. And even if we see 10% of the farms, 3,000 farms get hit with this thing, if it only reduces milk production by 1% on an annual basis, that's only going to reduce US milk production by 0.1%. Again, if 10% of the farms get hit, it's going to reduce annual production by 0.1%, which isn't very much in a market that typically grows 1.5% a year. I could see the potential for regional disruptions or short-term disruptions in the milk supply. There's only 300 or so dairy farms in Texas, while there's 5,900 dairy farms in the state of Wisconsin, much smaller farms in Wisconsin. But we do have the potential for a lot of farms to be infected April and May as those birds migrate north, which could create some regional tightness in milk. Or if enough farms all get hit in a short period of time, we could see milk supply tighten up enough to really impact prices. But again, at an annual level, I don't think this is going to be a major mover in terms of milk production or prices. If it does show up in the production statistics, it's going to show up as weak production per cow, which is concerning because we've had a lot of struggles in production per cow in the past 3 years. Historically, we've seen nice, consistent increases in milk production per cow each year as the genetics in the herd improve, as the facilities, the barns and milking parlors improve, as our understanding and management of the dairy cows improves. We get consistent gains in milk production per cow. But milk production per cow in February 2024, after adjusting for leap year, was only up 0.2% from 2021. Normally, we see 1 to 1.5% growth each year. What this doesn't take into account is the amount of fat and protein that's in the milk. And for the past 10 years, we've seen very large gains in the amount of fat and protein in the milk. There's 2 drivers behind this. The first is the breeds of cows that we're milking is shifting. We're moving away from Holstein and towards more Jersey and Holstein Jersey crossbred animals. But also, even the Holsteins today are producing, your average Holstein is producing more fat and protein than a Holstein was 10 years ago. The fat and the protein is the important part of the milk. The rest is sugar and water. The fat and the protein are what's needed to produce products like cheese and butter and the various powders. So there's an incentive to produce more of these solids in the milk to get paid more for that milk. So unfortunately, the USDA does not report that fat and protein data in the milk production report. You have to go to other places like the Federal Milk Marketing Order statistics and pair that back with the milk production data to really get an understanding of what's happening with the supply of milk solids in the US. So if instead of looking at milk per cow, if we looked at milk solids per cow was up 3.8% in February of this year compared to February of 2021. And what that means is that the milk production numbers that we're all used to looking at are really understating the supply growth that we have in the dairy market. This graph is my US milk production graph. Usually when we're talking about dairy supply and demand fundamentals, we're talking about year-over-year percentage change, which is the blue bars along the bottom of the graph. Milk production, as reported in the USDA milk production report, has been running below year-ago levels for the past 8 months, and our current forecast has it continuing to run below year-ago levels for the next 4 or 5 months. However, if you adjust this for the components in the milk, then milk production, after adjusting for components, has been running above year-ago levels for 7 out of the last 8 months. February was slightly negative. And the growth looks mostly positive moving forward. So it's important to recognize and adjust the data to account for the higher components that are in the milk. Our expectation is that the dairy herd is going to bottom out near current levels and that we will continue to see some growth in the amount of fat and protein that's in the milk, which means that during the second half of this year, we should see an acceleration in milk production growth as we start to lap over some easier comparables last year. So it's the expectation is some improvement in supply growth, but from a long-term perspective, the supply growth for the remainder of this year looks below average. Looking at the individual dairy products, butter has been the really outstanding product. Butter prices so far this year are averaging at record highs for this time of year. We're up in the $2.90 to $3 a pound range. Our record high was $3.50 back in October of last year. But for this time of year, $2.90 a pound is record high pricing. And the driver behind the strength in the butter market has been domestic demand. Over the last 12 months, U.S. domestic disappearance is up 9.5%. And with the type of supply situation that we have, we simply can't grow butter production at 9.5%. So the function of the market in this type of situation is high prices are needed to ration the available supply. I'm not sure if $3 a pound is high enough to ration the supply or not. We did get a slight pullback in domestic disappearance for February, but talking to people in the industry, it sounds like sales in March were pretty good ahead of the early Easter. Now, I'm a fundamental analyst. I look at the supply and demand numbers and try to use that to evaluate whether prices should be going up or down. And if you look at the butter stocks to use versus prices in the first quarter, the butter price was about 30 cents higher than what you would expect based on the stocks to use ratio. Really, the stocks to use ratio says we should have been at 240, 250 a pound butter. Instead, we were near 280 a pound. And we have a similar situation lining up for the second quarter as well. As a fundamental analyst, I look at that and I say there is still some downside risk for spot butter prices. But when I look deeper into the year, $3 a pound and higher looks justified given the stocks to use ratio that we're expecting. And when you work backwards, if you say $3.30 a pound is justified for October, if the cost to carry is 3 cents a month, work that back 6 months. Actually, right now, based on the cost to carry and where we think the market's going to be later this year, you could still justify $3, $3.10, $3.20 type pricing on spot butter based on that cost of carry. We have the opposite problem in cheese. Domestic cheese disappearance was, it hardly grew in 2023. And in January and February of this year, domestic disappearance was down more than 2% from last year. That's an unusual occurrence. When I went back and looked at the last 50 years worth of data, there's only been 2 years where we've seen an annual decline in cheese consumption in the US. The first one was 2008 with record high cheese prices and all of the economic problems that we had in 2008. And the second time was 2020 with all of the COVID disruptions to our eating habits. So it's it's unlikely that domestic demand is going to stay down by 2% for the remainder of the year. We should see improvement in cheese demand as we move through the course of 2024. Cheese makers have done a very good job of matching weak demand with weak production. And that has limited the buildup in cheese stocks despite the very weak demand. So cheese inventories are basically flat year over year. Cheese demand has not been good, but should improve. And when we look globally, cheese prices are still in the range of $1.80 to $2 a pound. And U.S. exports have been very, very strong in January, February. So fundamentally, I think the cheese market should be in the range of $1.70 to $1.80 a pound. We've been depressed the last couple of months due to weak domestic demand for cheese, which should be improving and could push this market back up into that $1.70, $1.80 range. Lastly is non-fat dry milk. It's the major milk powder that we produce in the U.S. Due to the relatively weak milk production, we've seen non-fat dry milk and skim milk powder production running below year-ago levels. Exports have been decent. Inventories held by manufacturers are running 20 to 30% below year-ago levels. We have a similar situation in Europe. The market, looking at the Northern Hemisphere and the data that we can see, looks fairly tight. The only bearish thing that we can really point to in the global powder market is New Zealand. Chinese demand for whole milk powder remains very weak, and that's a product that they primarily buy from New Zealand. So New Zealand processors are adjusting their product mix and producing less whole milk powder and putting that milk into butter and skim milk powder. So we have still increasing supplies of skim milk powder coming out of New Zealand that are keeping a lid on global non-fat dry milk and skim milk powder prices. The expectation here is still that we'll see some stronger demand later in the year that will help to lift non-fat pricing, but of the forecasts, I'm least optimistic or least sure that we can get a significant rally on the powders because it looks like that Chinese demand for whole milk powder is going to stay weak, and New Zealand will continue to shift milk into that butter and powder. So overall, it's a supportive outlook for dairy. Cheese demand should improve. Butter demand is currently too high and needs to slow down a bit. We are expecting better growth in milk supply, And that does lean a little bit bearish, but the expectation, the hope, is that we will see a little bit better demand on the back end of the year, and that should generally be supportive for dairy prices. There was one question that came in about increases in cheese capacity. There's a number of new cheese plants that are set to open up in late 2024 and through the first half of 2025. If all of those plants came online at their rated capacity, it would be about a 5 or 6% increase in cheese production. There's a couple of problems with that. First, they're not going to come online at their rated capacity. They're going to come online at some lower level, maybe 20% of capacity. There's the potential that this could flood the market with cheese, and it does set up some bearish risks for cheese late Q4 and the first half of 2025. It shouldn't be a factor in the market right now. But then secondarily, with the milk supply outlook that we have, it's going to be very interesting to see where these plants can actually get the milk that they need to produce that cheese. With that, I will wrap it up and hand it off to Gavin McPherson to talk about livestock.
Thanks, Nate. Can everybody hear me? See me?
Yep. You're good, Gavin.
All right, we'll get started here. I'll try to do my best here, Alfredo, to catch up and get through this pretty quickly. I'm going to hit the latest reports here that we just saw here recently. Cattle on Feed, which the monthly report just was released on March 22nd, and then the quarterly hogs and pigs report, which was released on March 28th. As we look at cattle on feed summary here, we were 1.3% above where we were a year ago, which was right at the high end of expectations. Placed on feed was surprising, up 9.7%, well above the trade guess and the highest guess on the trade estimate range. And then cattle market during February at 3.4%, which was below that average trade guess and on the lower end of that range. Just to make a mention, these numbers aren't bullish, and I know as bullish as the cattle market has been here in recent months, this, along with the prior biannual report, would suggest that maybe we are rebuilding. There's some significances in here on holding animals back relative to placements, and which is why we've seen some of the stranger things here in some of these numbers. But those numbers are not bullish, and when you sprinkle in some of the HPAI, the bird flu stuff Nate had been talking about, it caused that anxiety, but really the back end of these numbers is when that occurred. As we can see, cattle on feed, the graphics just running through there really placed for February the highest of the data set of the last, back to 1997 for the month of February. So some significant, increases that we're seeing here to these data sets. And then the final down here, average placement weights as well for the month of February, also the highest of the data set going back to 1997. So, those are not bullish things, although that's part of the fundamentals on placements and feed costs, grass availability, and where those are lining up. Projected cattle marketing is based on placement weight. StoneX is we were projecting now, obviously, as we go forward with that curve through April, May, June, July, pretty much right in line with 2023, and then actual marketings versus projections. Again, quite surprising to our StoneX numbers as well, our projections with those numbers coming in quite a bit above here the last 2 months. And then we'll move on here over to the quarterly hog and pig report. Just to start out, the very first line, all hogs and pigs coming in on March 1st up 0.6% over a year ago. We came into the report really relatively bullish. I would say the market has had a pretty good rally going into the report, and it had a very strong rally out of the report. Surprising to a degree, most of that rally and strength being predicated upon the breeding herd. So heifer breeding down only 2.1%, when that range was, in some cases, some people thought that we were going to be almost 5% less. A lot of losses occurred in the hog production industry last year, which led to and continues to lead to some sow liquidation as margins have turned. I think that will change. But ultimately, the report was really focused on, in my mind, on supply, current supply that we're seeing. The DEES-fed pig crop up almost 2%, which was on the higher end of that range and above the trade guesses. Our DEES-fed pigs per litter up almost 5%, which was really the shock and the offsetting factor of the decline in the sow breeding herd. This was well above the range of guesses and the high end of those estimates as well. None of those numbers I have circled except for the breeding herd really is anything bullish, and yet we've had a surprising rally here in the hog market. As well as animals that are on the ground. So those two weight categories to note, up 1.5% within the range of estimates, both above the trade guess average. But we'll come back to those in just a second. Again, those numbers would show us back or project us out to animals coming this summer. Heifer breeding, you can see we got to go back to 2016-15 to find a breeding herd at a lower level, but we've also went through a substantial period of growth as well through 17, 18, 19, and going into 20. So a great deal of expansion now followed by at least a reduction in the breeding herd, although much more efficient. And that comes back to the DEES-fed pig crop, which is really the third highest we've had for that period of time, going back to 2000, so in the last 24 years, as well as then our DEES-fed pigs per litter. Again, substantial difference from the prior year. And then all pigs, all quarters, you can see the third highest level there in a quarterly report here. So the efficiencies in the breeding, in the sow barn are incredibly good. I think if you talk to a lot of producers, it's really from the finishing barn to market where some problems occur. But right now in the sow barn, we don't need as many sows, basically. And then the projection here, again, kind of talking about the animals that are on the ground. And that period that we looked at there, June, July, and August, those projections keep us above, marketing's above where we were a year ago. Now, again, rationalizing the move in the market post-report, I think we added about $10, $8 to $10, depending upon the month we're talking about. Specifically in those summer months, we've seen spreads get out of whack, a lot of premium built in the summer, which is really contrary to what we might be seeing in these graphics as far as the supply situation is concerned. So that brings us to demand. So where is it coming from? Ultimately the demand driving in pork, as we talk about there at the end there for the quarterly hog and pig report. I'll jump in and start here with beef and veal. Much smaller percentage of beef and veal are exported to the rest of the world relative to pork, which is closer to 27% of production versus somewhere in the 12% on the beef side. But you can see globally, we are about 4% below where we were a year ago, the first line, whereas Japan being our largest trading partner there, running about 11% below where they were a year ago. And then to highlight China, as Nate mentioned China and Kathryn mentioned China there at the very beginning, in her meetings there with the IMF, we really, there's some problems in China and that's showing up in quite a bit of our relationships. Whereas China a couple of years ago was a pretty significant trading partner in a couple of our commodities here, they are receding quite quickly. And then I want to highlight Mexico, not only for beef and veal, up 17% on the year, but we'll also take a look at that on the pork side. And so really to highlight Mexico, one of the currencies as we talk about the US dollar, the strength of the dollar, typically as the dollar strengthens, we lose export demand. Their currencies can't buy as much as it once did when converted to US dollars. And so as we see that, the one currency that really has supported itself against the strength of the dollar has been the Mexican peso. And it's showing up pretty substantially in their buying now. Relative to beef and veal, we still see that really sub pre-pandemic levels, but it has improved over the last year and a half or so. But when we look at the pork market in terms of exports, globally, we're up 6%, and Mexico is the driver of that, up 3% year over year, while China right now, highlighted, they're down 46%, or running 46%, down 54% from where we were a year ago. Just surprising. And they would have been driving 2.5, 3 years ago. If we looked at this, China would have been above Mexico. So it's a substantial difference. Mexico really holding the baton at this point and helping drive some of the demand for the additional pork that we've been producing. Just to highlight that graphic there, and you can see well above pre-pandemic levels and a continued improvement from 2020 there in the bottom during the pandemic. Now that forward curve, as I mentioned, and this was April 8th. So as I highlight that summer month, now what we're looking at here is the CME index relative to the futures and where they're painted and where they project that CME index. The futures expire into the CME cash index, and relative to that, our April just went off the board there this last Friday, and that 89.62 number, as you see there, was actually just about 90, about 90.73, so about $1 better than where that graphic, that gray line or gray box is there right outside the red box, and the orange line converting. But those futures prices continued to carry some sizable premiums as we look at in the June, July at 107.97, 110.22, those numbers being, in the $20 range. We've had a pretty good setback here in futures prices in the last week or so, and a lot of that's been set back was gains that occurred post the quarterly report. So, I think right now futures are a little bit lofty relative to where we've been, although the cash market has been incredibly strong and somewhat supportive of that rally. Those two need to converge, and the question is the premium that's built in futures, still relevant? Now, what's driving some of the futures move is something I want to jump at and focus on here as well. And when we look at the CME Group's livestock market overview, I wanted to highlight, this doesn't happen very often, but the total lean hog futures open interest now is higher than the cattle futures open interest. That doesn't happen very often. I believe recently, when I just looked, this is April 10th, so a few days ago, I believe that still is the case, that we are still have a greater open interest in the lean hog market futures contracts than we do in the live cattle. With that being said, interesting that these graphs have changed quite a bit since I put them together, one of the challenges when we do these programs. But as we look at total open interest, the cattle, which has dropped now down below the 300,000 there, and the same thing with hogs at peak just recently, very close to the high water mark there on the red line, at just under 320,000 contracts. So very hot market, very large open interest in hogs right now. And relative to that, we can kind of begin to dissect who's a part of that. So in the CFTC's the Commitment of Traders report, we can see that lean, cattle, the producer merchant has taken advantage and have added, the 120,000, although that's not a historically high short position for them relative to the money manager long position of 53,000. We'll take a look at those graphics and where those numbers line up relative to the 138,000 short producer merchant on the lean hog futures, and the money managers long at 176,000. So those numbers are going to be numbers that we'll look at in a graphic in just a second. They actually increased. We saw the producer merchant get shorter, and we saw the money managers get longer in the last week. And in the decline that we've seen the last few days, the liquidation has been obvious and apparent in the money manager, and the replacement of those positions for the producers by lightening some delta, taking advantage of the break in the market. Money manager there again up at the upper end of history the last 5 years here for the hog market, as well as the producer merchant there being about as short as they've been. Both those numbers, that 76,000 number for the money manager versus 138,000 there for the producer merchant. Then we look at the cattle, 53,000 there, the money manager number just coming, had gone back up as we rallied, and now as we've kind of declined with the whole bird flu situation in the dairy and the potential of the beef herd, we're now seeing that come down a little bit, and the producer merchant maybe be coming to make some adjustments to reopen some upside. Some of that is apparent in the open interest change. I wanted to just get to the kind of the summary here, and you can see the break that I've mentioned. Really, in the July lean hog contract, I mentioned March 28th being the quarterly report. We'd had a pretty good rally from the beginning of the year, January, February, into the report, pretty sideways in March, and then a big rally out of the report, and then again, pretty big decline since the past couple of days. So just wanted to highlight that and kind of get a good feel of what's driving that as far as who's in the game and the open interest, as well as the cattle market here. This is the August contract. Pretty good run there from the December lows. And then recently with and again, March 22nd was that monthly cattle on feed, and what began the break. I think the continuation of that with the potential risk of getting the bird flu into that beef herd is another issue the market's trying to figure out. So the takeaways here real quick, where do we go? Keep a good eye on your margin and your budget. Right now we're in incredibly volatile times. You can't let opportunity get away from you. If you can make money and protect that profit, that's something you should be aggressively doing. Be proactive. When that opportunity shows up, make sure you're aware of it and doing something about it. The market volatility is going to continue. That's for sure. I think in every market we're talking about, maybe sans the grain markets at the moment, we're going to continue to see volatility. Consumer sentiment's a big driver of that. Energy markets, inflation, all the things that Kathryn and John or Josh mentioned to get us started. Those are very important factors as we think about our meat trade and meat consumption, consumer demand. But foreign animal disease is our biggest risk, and now we're dealing with that right now and the potential fallout. Every day that goes by, we're watching APHIS and trying to understand any new breaks. It's kind of like COVID, they've called it MuFlu or COVID, and talking about that with the idea of the potential of, that being another pandemic type of a situation. So there's a lot of fear mongering going on, a lot of volatility, a lot of uncertainty and emotions. And I think that becomes, part of what's driving prices to a degree. But remember, the fundamentals were there to suggest we should maybe not be at such high values in that cattle market at the moment, and questioning the height that we've seen in hogs. African swine fever is still out there relative to the high path avian influenza here domestically. Both are foreign animal diseases, and both have problems. What will create problems for our export market, as I just mentioned, incredibly strong export market for pork right now, especially to Mexico, which we can't afford to see that go away. So ultimately, the risk continues with all the geopolitical risks, as well as the risks to the consumer. As inflation increases, gas prices go up, the demand or where they're spending their disposable income, that becomes a big question mark. And, I think those are part of the first couple speakers today and raising some of those questions. So with that, Alfredo, I'm going to pass it over to you, and we can finish up with carbon. Thanks for the time. I look forward to the questions.
Awesome, Gavin. Thank you so much. Hi, everyone. Hope you can see and hear me well. Very interesting, of course, always learning from our colleagues. I'm the head of our carbon desk at StoneX. I'm sitting here in Miami office. We'll be talking a little bit today about what we do at the desk in terms of supporting clients manage climate risk. We're not here to discuss science or to dispute if climate change is happening because of human activity or if it is just a cyclical issue. The main idea is to recognize that climate change is happening. It's impacting our businesses. And so what we try to do is to think of ways and strategies of minimizing that risk, managing the risk, and eventually monetizing some of the climate action that we do in our businesses and daily lives, right? So why so much discussion lately about climate change, in addition to, of course, the, I would say, more frequent and intense climate events that impact us on a daily basis, also droughts and floods and changes in climate patterns that are affecting our crops and impacting commodities overall. So it is this slide shows us a very interesting picture of how the main risks to the economy are perceived today. This is a slide from the last World Economic Forum. It was based in pool with different individuals and in corporates and governments. And if we can see at the top right corner of the matrix, within the 10 top main risks to the economy, 5 of them are directly related to climate change. The first one is to failing to mitigate climate change, so not being able to reduce our emissions or capture carbon from the atmosphere, and not be within the goals determined under the Paris Agreement, and stay within 1.5 to 2 centigrades warming by 2100. So that's the first one. Second one is a failure to adapt to climate change. Of course, to be able to manage all of these climate events, we have to invest in infrastructure. We need to make our facilities more resilient. We need to be sure that we have proper systems in our crops to avoid losing or affecting yields. So that's another important one. Of course, the natural disaster and extreme weather impacts in infrastructure. And one that to me is very important is a natural resources crisis. That is, we're not only talking about water, we're not only talking about biodiversity, we're also talking about food security when we talk about it, right? So disrupting climate patterns eventually will make us have to change the places where we plant our crops. So areas that were multi-crop in the past are no longer multi-crop. Only 1 or 2 types of crops can thrive in the current climate conditions. So that's a very important one. And of course, the large-scale environmental damage incidents that affect us all and most of our economies. So that's one of the main reasons we focus so much on that. Also, there's a few things that make the markets move and offer eventually risks, opportunities for us as individuals and businesses. One important thing is to recognize that we are not doing this for granted. Most of us are taking action basically imposed by new regulation, right? So the primary instrument today, I would say, international agreement that promotes climate fight and climate action is the Paris Agreement. I think most of us have heard about it in almost on a weekly basis now. Basically, what this international agreement provides, the Paris Agreement, is that countries are assuming targets associated with decarbonization. So we're talking about 3 primary credits. We call them the national determined contributions from each country. So the primary goal is by 2030, reduce our emissions by 45%. So absolute emissions by 45%. Second primary goal is by 2050 to become carbon neutral or net zero, right? So the balance between emissions and sequestration will be 0. So we're sequestering more carbon from the atmosphere, or at least equal amount than we are emitting. And the third goal is by 2100, which is to limit our warming by 1.5 to 2 centigrades. So that's basically coming through regulation. Governments are regulating at federal and at a subnational level. Also, we have some regional initiatives, like in US we have RGGI, in Europe we have the European Union Emission Trading Scheme. So there are several different kinds of regulation all over. The second primary driver moving climate action is the increased regulation from the finance sector and investment sector, right? Investors and banks are looking more and more into environmental and climate performance when evaluating businesses' investments or granting money for investments. So that's becoming also a very important aspect that impacts our businesses. And eventually, with a better climate performance, we can access, for example, capital at a lower cost, lower rates. We can issue green bonds at lower rates. So that's another important aspect. Also, there's the recognition of the main corporates. They're assuming or taking voluntary pledges, because the issue associated with voluntary pledges is that we all recognize, people that are in the market, that with government action, we are not going to be able to get to our goals. We're probably going to get by 2100 at 50% or maybe 60% of our goals. So the gap has to be filled in with voluntary action from corporates, or increased appetite from ambitions from governments, which we don't believe will happen. So we are seeing more and more in the tech space, in the oil and gas space, in the transportation space, basically everywhere, companies taking aggressive action above and beyond regulation. So that's another important thing. And last but not least, I'm going to jump to the point number 5, and I think it's relevant for us here, is the increased pressure from demand side. We're seeing companies, for example, clothing companies in Europe, saying that starting 2025, the end of 2025, all their clothing are going to be carbon neutral. That puts a pressure on the manufacturing companies that do the clothing in Vietnam, Malaysia, Thailand, that in its own right put pressure on the cotton exporters, for example, and the cotton producers. So it trickles down to all the way to the farmland and farm producers. Right? So that's very important. It's increasing also as a trend. So this slide is just to show you how intense the regulatory dynamics on carbon is globally. So every different color that we see in this map is a different kind of initiative. So it's an emission trading scheme like we have in Europe and California, or it's a carbon tax that as we have in Colombia and Mexico. Brazil has recently enacted emission trading scheme in the similar design as we have in Europe. So significant dynamics that impacts our bottom lines. For example, state of Querétaro in Mexico, the carbon tax is $37 per ton of CO2 emissions. It's to all sectors, not specific to a certain sector. And you basically have to present at the end of the year your carbon emissions and pay a tax for that. So it's quite interesting and important. So we need to understand that to properly manage our risks and understand what are the opportunities associated with these dynamics. Another relevant regulation that I thought I should point out is that Europe has recently passed another regulation called a Carbon Border Adjustment Mechanism. It's basically a carbon tax, border carbon tax. Those 6 sectors that I'm listing there, cement, iron, steel, aluminum, fertilizer, hydrogen, and electricity, are the first ones to be regulated. So basically what it means is that every time that you export into Europe, you have to present the carbon intensity of your product and pay a tax based on that, right? So that's pretty hefty. The price today is equivalent to what we call a European Union allowance, which is around 60 to 70 euros per ton. Very important cost. As you can see, we don't have agriculture products, food products yet in there, but it's coming. We expect that by 2027, those sectors will also be regulated. So that's an important risk matter that we have to observe and manage to minimize impacts to bottom lines. So this is pretty intense, and US is also discussing a similar provision, and we expect to see something like that in maybe a couple of years in US as well. US also important to mention that this year they enacted a rule. So the Securities Exchange Commission is now requiring all listed companies to report their emissions annually, and also their decarbonization plans with key measurable indicators. So this is also an indication that there's no penalties, there are no fines associated with that yet, but that's the trend. I think we believe it's coming for the companies that are not going to improve or deliver on their plans, right? Another important aspect that is really impacting the dynamics of international trading is the heavy regulations on shipping associated with carbon and decarbonization of the shipping. This is a slide from the IMO, the International Maritime Organization, where we can see the evolution of the specific industry about carbon emissions. One important new regulation, which is still not enforced by law. There's no major implication in terms of fines, but it affects the qualification or the classification of the vessels. Is a new rule that was enacted in 2023, which is the IMO strategy on reduction of greenhouse gas emissions, that basically affects, as I said, the classification of the vessels that will no longer be able to be used for certain type of cargo, and will not be able to eventually travel to some final destination, some ports in Europe. So that is impacting shipping costs. It will affect routes, and it will affect, at the end of the day, bottom lines, especially for companies that export into Europe. So something very important on that perspective as well. And this is increasing, and we believe that it's going to be even more enforceable in the coming years. Similarly to the shipping industry, we see similar dynamics associated with airlines. So air cargo transportation also impacted. IATA already have a plan in terms of decarbonization flights. There is a specific standard called CORSIA, which is the way that the industry has decided to measure performance on the flights. So those two elements are really putting pressure on airlines in mostly promoting transition into sustainable aviation fuels, and also impacting for ourselves, for users, for example, impact on cost of cargo, affecting for individual passengers that are limiting the what we can bring with us on board. So that's an interesting dynamics that also affect bottom lines because of the cost of cargo shipping through airways. Right? So how we manage this, how we prevent that all of these dynamics impact business. So the way we see it, the way StoneX look at it, carbon is just another asset class for us. So we need to look through the risk management perspective, right? So eventually, if we properly manage that, we're going to be able to monetize some of this action and minimize the impacts of taxes or levies on us. So there's several risks that have to be observed. Of course, the physical risks associated with the natural disasters, climate events, but also the regulatory risks that we just pointed on, the market pressure, all the demand side pressure for decarbonization. All of the things are risks, but also there are opportunities, right? There are new technologies being developed. There are premiums paid for decarbonized products. There are markets that eventually, like European, they're willing to invest in decarbonization products in developing countries. So you can implement carbon projects that are going to generate offsets that can be traded in international markets. So there are both risks and opportunities, but if they're incorporated in the strategic planning of the companies from top down and actually implemented as part of the company strategy, not only as an individual component of ESG of the company, we believe we have seen companies really being able to pay for climate action without affecting bottom lines, while mitigating risks and eventually increasing market share. So the message here, I would say, more than anything, is that please consider carbon management in your strategic planning. We're able to help you understand those risks. We're able to help you eventually design a strategy and also monetize action if that's a real possibility for you. But the regulatory dynamics, market dynamics are there, whether we believe or not on climate change being caused by human activity. So that was the message, the main takeaway of my presentation. So Cassie, I'll give it back to you for closing remarks. I don't know if we have time for Q&As, but I'll be available for any questions later if needed.
Wonderful. Thank you so much, Alfredo, for that last bit on carbon. We appreciate that. And I know there were some questions in the chat, and we're running just on time. So what we're going to do is make sure that the speakers will address those questions later on. So that will wrap up our webinar today. I'm going to leave you with a link to our Controlling Commodity Costs podcast here. You can tune in to learn about to learn about industry best practices across hedging methodologies. We talk about everything from ag markets to energy utilities. We talk about fats and oils procurement, OTC tools, hedging methodologies, as I mentioned. So scan the QR code if you're interested in that, and you can follow along to our podcast. That's a free podcast. Again, thank you for taking the time to join us today. I wanted to say also thank you to all of our speakers today for joining and taking their time. We hope that you all have a great rest of your spring, and we hope to see you back for this Commodity Insights webinar series this fall. Thanks again for joining. Have a good day, everyone.